Star Entertainment's shares have plummeted yet again, down another 50% to a mere 12 cents at the time of recording. Down 98% from 4 years ago, and that's when its doors were closed during the height of the pandemic. Over the past week, Star has been the worst performing company in the entire Australian Stock Exchange. Now, Star is reportedly on the brink of imminent collapse. From news.com.au, and I quote, "Casino giant Star Entertainment Group is on shaky ground as fears of its collapse grow, with thousands of jobs and the future of the new Queen's Wharf precinct potentially at risk." The Star's update this week on cash and liquidity raised concerns as the business revealed it was burning through its cash reserves, leaving shareholders worried the business would not make it past February. The gaming giant's latest report showed its cash balance plummeted by almost half to $79 million in December of 2024 quarter, citing difficult trading conditions, capital expenditure, legal and consulting fees, and a $15 million fine imposed by the New South Wales Independent Casino Commission. According to Morningstar analyst Angus Hewitt, the embattled corporation could collapse by the end of February if it continued burning through cash at this rate. Quote, "We now incorporate a 50% probability that Star falls into administration," he said. "Personally, I think it's closer to 90%. Now, if you're unfamiliar with how Star got into this position despite being a protected monopoly in a high-demand sector, we've published 2 videos cataloging some of the most spectacular and cringeworthy corporate malpractice ever. In this video, we explain how, looking at the landscape, Star Entertainment is almost certain at this point to go under. And while good laws oblige me not to give financial advice regarding investors, if you happen to work for Star, please avoid taking on new financial commitments that depend on you having a job, and perhaps actively start thinking about alternative employment. So what is the state of play at Star? Well, at the time of recording, Star Entertainment's market capitalisation is just 360 million Australian dollars total. To put that in perspective, in 2024, Ensis Group bought the World Series of Poker, just a live tournament series, at 2.5 times that amount. Star's debts now exceed the company's total valuation. This is despite owning 3 massive hotel, resort and casino complexes in some of Australia's most iconic and expensive locations, including the brand new multi-billion-dollar Queen's Wharf complex in inner city Brisbane. In September 2024, Star Entertainment secured a $200 million loan by a conglomerate of lenders payable across $200 million tranches, the second of which contingent on a range of milestones being met, including at least $150 million of additional lending from other suppliers. And yet, as of today, Star has less than $80 million in the bank, having burned through $107 million in just 3 months. Now, I do think the company could have been saved by selling the Darling Harbour Star Casino in Sydney. This would have attracted a large number of high-value buyers, and the cash would have paid off all of Star's debts, allowed Star to divest from an unfriendly regulatory jurisdiction in New South Wales, and given Star significant cash reserves to tide them over until the Queen's Wharf complex became profitable. Yes, it would have been painful. Yes, it would bring in another competitor into the Australian market, and yet I submit that any dispassionate analysis clearly shows that move was correct. Instead, Star took on hundreds of millions of dollars in new debt at 13% interest at a time when it was already bleeding money. And now it's simply too late to sell the Sydney Darling Harbour complex because everyone can see Star circling the drain, and therefore potential buyers aren't going to pay what the asset is actually worth, given their expectation of a fire sale. And aside from the massive fines and compliance issues Star continues to suffer from state regulators, the company has been locked in at least 3 costly legal battles, all of which are crippling what's left of the company. First, the developer of Queen's Wharf is suing Star for cost overruns and delays. Second, the premium retailers who are supposed to go into the Queen's Wharf are alleging fit-out failings and lease breaches. And finally, and my God, this has got to be the most absurd, a Cypriot businessman has successfully sued Star over the sale of a 145-foot Benetti super yacht. Now, this case was settled at the end of December 2024, but it's worth delving into a little because it's revealing about how Star operated for many years. In 2019, when Star's capitalization was about 40 times what it is now, they bought this yacht for an undisclosed sum and then refurbished it for an additional $4 million for use by, quote unquote, premium customers. Now, Star since allegedly agreed to sell this yacht to the Cypriot businessman for a sum of $8.6 million, even though yachts of similar size and quality routinely sell for $15 to $20 million. According to the lawsuit, Star tried to renege on the deal. Now, as I said, this matter has been settled, with the super yacht permanently sailing out to the Mediterranean, never to be seen again, while Star is left with another massive legal bill. Meanwhile, Star's other assets continue to be sold at bargain-based prices, including the Brisbane Treasury Building, an architectural icon in the city's inner centre, for just $67 million, 1/4 of its previously assessed value. All of this has been a desperate attempt to keep the cash flowing until such time as the Queen's Wharf development becomes fully actualised and delivers the company mountains of money like a fairy godmother with a pair of magic slippers. In sum, the entire strategy rests on the proposition that Star has valuable and profitable underlying assets, and it's just a matter of short-term liquidity. If you merely carry over with enough cash to keep the lights on, everything will work out in the end. Indeed, this was the entire rationale for the conglomerate providing the loan. At that time, Solpat's CEO, Mr. Todd Barlow, said, and I quote, "I think what happened with Star is that they had a short-term liquidity crisis in that they had cost overruns with their major asset in Queensland and they needed to fund that shortfall. Now that they've done that, I think they're on their way." Now, this video isn't aiming to dunk on Todd. I understand why he and others thought this. As the theory went, Star would repair its relationships with state governments and have enough cash to continue operating. This would mean it would make a profit, they'd sell the company to a private equity buyout at a huge windfall, pay off the debts with interest, and then go hang out with that Greek Cypriot businessman in the Greek islands. Unfortunately, this perspective also betrays a high degree of corporate and gaming illiteracy. There are two critical problems with this plan. The first is the long-term viability of the Star business model and whether the past success of Australian casinos will be replicated in future success. So let's look at this. On the positive side, Star, Crown, the Federal Group, these companies have enjoyed protected gambling monopolies in their respective jurisdictions over many decades. But that's not how people should be looking at the casino market today. Up until a few years ago, a major contributor to a casino's bottom line were the big whale businessmen coming in from Asia, particularly China, whose gambling trips were facilitated by junket operator intermediaries. These high flyers could lose millions of dollars an hour at high roller tables and then come back for more. But this cash cow has experienced a massive crackdown, both on the supply side and the demand side. The Chinese government has gotten serious about restricting the outflows of gambling, whether it's coercing the Philippines to ban online operators known as the POGOs, or just outright threatening its own citizens not to gamble abroad, something which is now explicitly illegal for Chinese people. In Australia, reports of money laundering on an industrial scale resulted in public outrage and multiple royal commissions. Junket operators are now heavily regulated, if not banned outright, while incentives and inducements for overseas gamblers to come to Australia have been radically curtailed. Meanwhile, new major casino resort complexes are popping up all across the region. Aside from Macau, there's the Philippines, Korea, Cambodia, Vietnam. They're all opening casinos at breakneck speed. Even gambling-averse Japan is building its very first casinos, while Thailand is legalizing onshore gambling for the first time, aiming to turn Phuket, Phuket, Bangkok, and Chiang Mai into colossal casino districts. Even Muslim-majority Malaysia has the Genting, Resorts World, and Sky. Not only does this provide Asian gamblers with much closer, cheaper, and honestly better gaming experiences, it also means that for Australian gamblers for whom flights to Southeast Asia are often cheaper than going domestic, well, they're also going to go overseas and spend their money abroad. Indeed, showcasing these opportunities from a poker perspective is what our channel, Poker Room Review, is all about. So yes, the geography is such that casinos have enjoyed monopolies within jurisdictions, but that competitive map is increasingly regional, and those able to gamble big obviously can afford to travel. And then even domestically in Australia, while online casinos are prohibited under the Interactive Gambling Act, and outrageously online poker is as well, the fastest growing form of gambling is still apps, particularly sports betting. If you're from the United States, you'll now be experiencing this trend firsthand, but it's been the case in Australia for a while longer. With market share increasing year on year, the younger, primarily male demographic is being captured by the online operators who prefer to gamble watching sports rather than frequenting brick and mortar casinos. The only option left to Star's board or Crown's Blackstone owners is to bleed their local, lower income, habituated gamblers even more than they already were, leading to the next problem: community backlash. Between sports betting and electronic gaming machines, the Australian public is increasingly fed up, viewing the whole industry with a high degree of antipathy. After years of scandal, malfeasance, and addiction horror stories, pressure towards gambling reform has been increasingly irresistible, being one of the few areas of political concordance between the Green left in Australia and the religious right. Major changes have now already occurred. Since November 2024, a mandatory card play has been introduced to Sydney Star, resulting in an immediate further drop-off in gaming revenue at that venue. Meanwhile, a suite of new restrictions targeting electronic gaming machines specifically were introduced to Victoria's Parliament that will definitely hit Crown. Now, I for one think that Australia's casinos could still be vastly more profitable and sustainable than they presently are, while not actually being hated by the broader Australian public, if only casino operators understood the business that they're in. But that's a video for another time. Suffice to say, casino operators across Australia are jumping on every bloody rake in the garden. The second problem with Star's creditor logic, beyond just not understanding the market, is not thinking clearly about who they expect as a buyer. Remember, the ultimate goal is not for Star to create a sustainable business, were that the case, they'd have sold Sydney Star already, but rather to break even while being asset rich so that they can attract a private equity company who thinks they can acquire it and turn a huge profitable cash cow. That's explicitly why Steve McCann was brought in as the new CEO, to repeat the miracle he pulled off at Crown when he sold it off to Blackstone for $9.5 billion. But this happened before the casino bottom lines had been significantly impacted by these trends. Even though the market had already radically shifted at the time, the pain had not been felt. On paper, everything at Crown seemed okay. And yet Blackstone know perfectly well they got fleeced. They spent way too much money buying Crown Resorts, and now the company's model and cash flow is increasingly fragile. And yet Star's whole strategy depends entirely on private equity firms not having learned this lesson. So even if Star were to solve all its immediate problems, the idea that Blackstone, KKR, CVC, or Carlyle are going to swoop in on a white horse with billions of dollars is pretty hilarious. Thus, short of a very big injection of some very dumb money, Star is almost certainly going under. And what's more, given the sordid tale of what brought the company to this point, it's perhaps best treated just as a warning to others. Again, I wish nothing for the best for the many staff and dependents who work for Star. I hope and expect that the Queensland and New South Wales governments are preparing for the collapse and can ensure the leave, super and wage entitlements are quickly dispersed. And just to finish up, according to the Australian Financial Review, Steve McCann's remuneration, includes a $2.5 million salary, a $7.5 million sign-up bonus, and a $5 million short-term no-hurdle bonus. As I explored in the last video, this is the board's fault, not Steve's. But my God, man. Anyway, I'm Crispin, and until next time, goodbye.